Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles Podcast. I'm also the founder and CEO of Family Office Association. Really looking forward to today's discussion, and to give a little context behind my questions to my interview subjects, I wanted to give a little bit of background to who I am and kind of what we do. In my opinion, it's vital for families and their family offices to understand their vulnerabilities and become resilient so they can mitigate risk and prepare and prevail in times of crisis. What I do is I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose and refining vision, governance structures, systems, processes, and culture that successful families and their safeguard family offices need in order to thrive. I help families create or reinvent their family office to be of institutional quality and highly adaptive. My process engages all generations in the family and focuses on designing a generationally dynamic family office focused on people, systems, and technologies that aligns the desires and capabilities of the rising generation and is able to triumph over challenges. Today's interview and podcast is titled Investing and Activism in Micro-Cap Stocks. It features Marcus Frampton, founder and author of the Micro-Cap and OTC Stock Letter, and Marcus also happens to be the CIO of the Alaska Permanent Fund, which is a $65 billion allocator. Our discussion today is going to be strictly focused on micro and nano cap stocks. And again, these are Marcus's personal opinions, not reflecting from the Alaska Permanent Fund, and it's very nice to have him on from a personal perspective. Marcus, welcome back to the show.
Well, thank you for having me, Angelo. I'm looking forward to this.
Well, thank you. I've really been looking forward to it, and this has garnered as much pre-buzz as probably any interview I've had for probably the last 2 or so months. So this is a subject that is so rarely covered among families of great wealth, and how truly, and I'm not necessarily recommending it unless they really want to be that active, but with some of the sizes of especially more nano cap companies, or what other countries may consider micro cap, a family of great wealth could more than move the needle. And again, not every family may necessarily want to do that and be that active. Why don't we begin with, and I know the definition may adapt a little bit around the world depending on their local markets, but broadly for more of a North American audience, what's the definition of a micro cap stock?
Sure, there are a number of definitions out there. I've seen billion and below. I tend to focus on stocks with a market capitalization below 300 million. A lot of equity investors think about the Russell 2000 as it's the small cap index. Micro is below small cap. In the Russell 2000, you'll have on the higher end some companies with 2 or 3 billion market caps going down to several hundred million. So there's a few definitions out there, but when I say micro cap, I'm generally, for my purposes, talking about 300 million and below, and that's a market where there's basically no institutional investment. So it creates opportunities. It's also the reason I focused on it is I wanted an area that doesn't conflict with what we're doing at the Permanent Fund, and we and other institutional investors aren't active in that kind of 300 million and below market.
And I think that's an important point for our audience more focused on family offices to understand. The so-called professional institutional investors, 99% of them are not active in this market. You're not competing with them. They're not driving up costs. They're not making the markets more efficient. Therefore lies the potential risk, but also the opportunity. There are some smaller activist funds, usually 100, 200, 300 million, that may dabble in this, but they're relatively, again, few and far between. And Marcus, I would say that your definition up to 300 million, I think the audience should realize that, especially in so-called micro and even nano cap markets, especially outside of North America, the companies may be much, much smaller than that, possibly market cap of like tens of millions, if that much.
That's right. I mean, I think that, I'm not breaking new ground here with this observation, but I think the IPO process and the capital markets in the U.S. are kind of in need of a bit of a reboot. You've seen it with Spotify's direct listing. There's fewer and fewer companies going public, and they tend to be larger and larger. Whereas if you look at Toronto or Australia, it's very common to have $10-20 million IPOs, and that used to be the case here. And I think it's a reflection of just how the kind of capital markets ecosystem and regulatory frameworks grown in the U.S. that it's no longer attractive for a 500 million equity value growth company to do an IPO here for cost and other reasons. And so many people have observed and bemoaned the fewer and fewer public companies in the US. I think the number, used to be 6,000-7,000, and today it's 4,000 on exchanges in the US. But, going to the over-the-counter market, that's a whole different ecosystem with close to 10,000 securities trading. So there's a lot to sift through, but it's actually a bigger market than the listed market in the US if you're talking about over the counter. And to your point, yes, other countries have built financial ecosystems where, companies are going public with sub 100 million market caps. It's not happening here anymore.
True. And we'll get a little bit to some international exchanges and opportunities for families there. And really, truly now more than ever, many families, especially those of wealth that would have their own family office, should be more active looking globally and be effectively international investors. That does require more time, effort, and resources, but it may be worth that effort. We already kind of hinted at it, but we'll dive a little deeper. What would be some of the main reasons why a family of wealth, a family office, would want to potentially put part of their equity allocation in micro caps? I think the core one is going to be one that we already addressed, but I'll let you reflect on it deeper. It simply is a significantly less efficient market than larger cap stocks that often have, again, Wall Street knows all about them. There's a million analysts, institutional investors are all over them. But what would be some of the core points of opportunity that you would gauge for families and family offices potentially investing in micro and what I may even call nano cap stocks?
Sure. I think there's an argument that family offices should invest directly, not through a fund manager, into microcap stocks. I think it affords, and this is something that's appealed to me, is an opportunity to build a position in a company with not an enormous amount of capital. It varies on the situation, but getting in a position where you can buy a meaningful stake, have a dialogue with management. And these are things that just aren't possible in large listed companies. And it's just an underfollowed market. So I think there's an opportunity for family offices to internally do some work and find situations that they like, that they think have quality management, a good position business, and to build a position and have a kind of a partnership that you wouldn't have if you buy stock in a larger company. I think the other point is just, you touched on it, the inefficiency of the market. Like a top quartile large cap equity manager is a hero if he's outperforming by 20 basis points. And I think activity in the less efficient microcap market, you'll have a broader range of outcomes depending on the skill of the investor. And that should be appealing if you believe that you can do the work to be a good investor in that market. And I think it's a little bit easier to analyze these companies because they're smaller, more straightforward. Like you've talked about the insurance market in some past podcasts. You pull up MetLife and it trades at a severe discount to book value. And a large reason is that a company of that size is very hard to analyze. You have to understand the derivative positions. You have to understand the long-term exposures they're going to have from rising health costs, et cetera. There's a whole market of micro-cap and over-the-counter insurance companies that are pretty easy to analyze. And some of them trade at similar discounts, to the situation I just mentioned. And I think it lends itself to having an edge from having read the annual report. Whereas if you read the annual report of MetLife, you do not have an edge.
Yeah, I mean, many of my audience, and thank you for following me on YouTube or podcast, but for specifically my member family offices, we've been diving very deeply into multiple issues this summer heading into the now fall season, and focused on being more international, proper structuring in the US and really around the world, and activities being active in banking, in insurance, and possibly controlling interest. And that will be a very deep discussion. We've covered the subject, including a little bit with our Swiss discussion yesterday. That will probably make it up to my YouTube shortly. And we have very, very deep discussions on creating or buying insurance companies beginning next week. And then probably, I think, the number one person in the world, he's in Switzerland from a legal perspective, on buying banks in Europe. But this is a way, and we're not going to get into the potential tax benefits per se deeply in this kind of dialogue, but there are advantages, especially for $500 million plus families investing in insurance companies and banks and potentially a controlling interest. And again, some of that I keep a little close to the vest, except for some of my consulting relationships, but we're becoming more open with it. In the next month, you'll see more on that. I think people should understand that because the markets are, especially in other areas outside of the US, outside of North America, where although the SEC, we could argue, is a little onerous, hopefully that also has some good aspects to it relative to so-called protecting us. There are potential for more public company frauds, I'm assuming, unfortunately, with these kind of companies. So again, a reminder to people, this is a challenging market. There definitely is downside. There's more frauds. And again, this is something, in my opinion, you should be an astute investor, probably a qualified purchaser plus, but that's just my personal opinion. And again, invest carefully and nimbly at first, and then get more comfortable to see if it's something you want to research and be more active in. How did you even start doing this, Marcus, knowing all the things that we just said, some of the rewards, but some of the risk? What made you take the leap?
Yeah. Of people I talk to that are active in this market, a really high percentage of them kind of, always knew they wanted to be an investor, read the Warren Buffett's partnership letters and are just kind of dyed-in-the-wool value investors. And I didn't take that path. I graduated from UCLA in 2002, and I worked at Lehman Brothers doing investment banking for a number of years. I worked at a private equity fund for a couple of years, and then worked at a portfolio company of a private equity fund for a couple of years. So I generally, getting into the business, was most interested in working on higher profile transactions, bigger companies. And I appreciate value investing, but I'm not someone who's like always been a value investor or, read everything that Warren Buffett's ever put out. And so I wasn't focused on this market at all until around 2012, 2013. And that's when I moved up to Alaska to start working in my current fund. I got a little bit more active on my personal account just because I had a little bit more time. And I would, generally run stock screens and look for criteria that I thought was interesting. A favorite screen of mine was just public companies in the US trading at under 5 times LTM EBITDA. And, I'd always have that screen up, and, you go through the list and it's kind of a negative screen. It's like, if a company is, the philosophy, at least for me, was very basic. It was kind of like, if a company has some decent growth, a stable business, good management, they probably are worth 5 times EBITDA. It's very simplistic. And so you have the list of, at any given time, there's probably 300-400 companies in the US that trade under 5 times EBITDA. And I kept gravitating to the smaller companies because the larger companies that trade at those multiples tend to have something wrong with them. And then, it's kind of the negative screen that I just described. I got involved in 2013 in a company called Callaway's Nursery, and it was the first, microcap stock investment I made. And I ended up investing a few $100,000 in it. It was probably 15 million market cap at the time. And I didn't really know what I was doing. It was trading over the counter. They didn't file financials with the SEC. And I got somewhat lucky because there was a very astute investor named Peter Kamen who was a 20% shareholder. I didn't.
He's a well-known investor.
Yeah, and in his prior life had invested out of a very large fund in kind of an activist format. And I didn't know that because they don't file proxy statements with the SEC, and I didn't know their shareholder base other than I knew management owned a lot, which I thought was positive, but can also be negative because when they get up close to 50%, they can kind of control and do what they want. And Peter ended up running a proxy contest and controlling the board and took it in a little bit different direction. And the company's stock, went from, I was buying it under $1 a share. By the time I sold too early, which is a problem with value investing at times, I probably sold at $2. It's now at $6 or $7. So,
wow.
It was a latent opportunity for someone like Peter Kamen to turn it in a different direction. I think I got lucky because if he wasn't in the stock, the catalyst wouldn't have been there. And so that was my first investment in the market, and then it worked out well, and I have continued. And at any given time, I have a handful of positions that I'm building.
And what are some of the exchanges in North America that these OTCs are traded on?
Well, they're not traded on an exchange by their nature. So, there's a company called OTC Markets that is
Right.
the kind of the infrastructure provider to this market, and they've got different tiers based on the level of disclosure that the companies, provide. I think it may be beyond the scope of this discussion, but it's worth noting that last week the SEC introduced pretty sweeping regulation of the over-the-counter market. And so I spent, the weekend with a 300-page, SEC ruling trying to understand it. And I mean, the theme of what they're doing is trying to create some uniformity. So these stocks aren't on an exchange. There are tiers on different levels of disclosure. For some of them, they're still SEC filers, but they're not exchange traded. Others put their financials on their website. Others, you've got to kind of hound management to get the financials. And the SEC has tried to create some uniformity. So if you, and the way they're exacting that policy is that brokerage firms aren't going to be allowed to quote bid asks on these stocks unless they provide public financials, which is something like 30% of the market is dark stocks, where if you're a shareholder, you can get an annual report, but otherwise you can't. So I think that this development is going to, there are people that are pretty upset about it, people that own stocks in dark companies, but I think that more SEC involvement is going to make the market a little bit more vibrant and more accessible to people that, are a more casual investor.
That's true. You said that for some of the companies that are dark, but if you're a shareholder, you could get more detail. Could you, in theory, just buy a couple of shares, or there likely needs to be a minimum so you could start to get more information before you decide whether to invest more?
Typically, it's just one share, and then you'll end up on their distribution list. And different companies are different. Like some will send you the last few years of the annual reports. Others, you're just going forward on the distribution. But that's all changing with this rule. I think the market will be bifurcated between companies that submit to this regulation and provide it in a uniform way to the whole public, and companies that aren't willing to do it. And then those will go to what's called the gray market, which I'm not active in, and it's very difficult to find a way to transact in those shares. And you're basically a private company at that point.
Yeah, we may get into a little bit of that, but related to that note, I'm assuming there's still people listening or thinking, I mean, I may have an interest in wanting to be more involved, but I'm going to need some level of research. When it comes to larger companies, it's so easy, but that's what makes them efficient. So there is a trade-off here, but there are certain resources. I believe you're a fan of Capital IQ. If you could talk about some resources, including them, that people may want to subscribe to and use if they're looking to be more active in micro and nano, that could give them some data points.
Yeah, so Capital IQ is a data service that I subscribe to. It costs money, I think $15,000 or $20,000 a year. So for a casual,
it's pretty expensive.
You wouldn't want it. The main thing that I get value out of from Capital IQ is running stock screens. And so, one that I've been doing recently, I mean, one of the most interesting things in the markets of late is companies coming out with June 30 quarterly reports, because the March 31 numbers didn't really factor in what was going on with COVID.
Of course.
And so there's, like Madison Square Gardens had literally zero revenue for the quarter ended June 30. So you can do stock screens on Capital IQ of, whose revenues and earnings have held up in this environment. And you can extrapolate from that if it continues longer than people think, those are the safer situations. So I run screens on Capital IQ on any number of dimensions. For someone who doesn't have that, I think for idea generation, instead of screening, you can, there's a number of really good like blogs out there. I mean, I've started writing one, so that's one source. There's one called OTC Adventures, and one called Oddball Stocks. So people can follow kind of blogs and newsletters for idea generation, and then to do research on a company. I don't think you really need Capital IQ. At that point, it's more about getting your hands on, the company's financials, maybe having some interaction with management if you're going to build a big position, and developing some thoughts on the industry, which is, general information out there that's not specific. The way you develop a view on an insurance company, whether it's micro cap or large cap, doesn't matter. It's at the same place as industry research reports, et cetera.
And I know it's a very basic question, but I want to, cover the foundational aspect of it. Because you said, again, traditionally exchanges, it's just not how this industry works. If I'm able to subscribe to your newsletter, to others, I do some level of diligence and research, and I want to move forward. How do I move forward and buy these technically public companies? Does my traditional brokerage likely cover it? How do I do that? What's the mechanics behind it?
I should mention also, because it may not be obvious to everyone, what it means to not be on an exchange. So if a stock's traded on the New York Stock Exchange and you have an account at E-Trade or Fidelity and you enter a buy order, it gets routed to the exchange and they match the buys and sells. Any stock purchase, there has to be a matching function between sellers and buyers. In the over-the-counter market, it happens on something called an interdealer quotation system, and OTC markets is the primary one. So if you have an account at any of the online brokers, you enter a buy order, it gets routed to that interdealer quotation system and gets posted. It's very ill-advised to do market orders in this market because they tend to be somewhat thin. They trade kind of like bonds with a bid-ask spread. So going into a situation, you would go to OTC markets, enter the ticker, look at what the bid ask is, and then you have to make a decision. Do you want to hit the ask and pay a little premium, or do you want to just put a bid up a penny more than the current bid, which is usually the smart move. It can be very frustrating to trade these stocks because you do the research, you decide you want a position, and then you have to be pretty patient building the position, because if you just go into the market, it's such a thin market that I've seen, stocks get driven up. But at times, if things are so undervalued, it's worth pushing the market up a little bit to get a position that you want. And that's just a judgment call.
And let's go back to that first investment you made, that although you did exit early, you basically, it looks like you doubled your money relatively quickly. Again, maybe a little bit lucky that Cayman happened to be involved through his family office, ironically enough. But for a company that might have had a market cap of 13, 14, 15 million, your 350,000 was probably enough to get some attention from the founders or major shareholders. And that's what I mean about the activism part, that for relatively modest amounts of money, I mean, you don't have to be Carl Icahn here in large cap stocks that have all these poison pill strategies and the days of Ivan Botsky and barbarians at the gate. I mean, that was decades ago. It still is possible to some degree, and we've had many wonderful activist investors, but it does appear to be getting harder and harder. But within micro and tiny micro to nano, a couple of 100,000 in theory, and again, these may be very risky investments, but that could be enough where you have a level of they may be listening to you and possibly invited on the board, or you can maybe push to be invited on the board. Can you talk a little bit about that?
Yes, I think that, I'm not a huge fan of pure activism because, there are a lot of disadvantages to the investor. And some firms do it very well, but I think it's a very challenging strategy. The larger public companies generally have brought in, defenses in the form of, in some cases, poison pills, in other cases, staggered boards and other things that make it very difficult to, achieve control and influence. I've always found in the microcap market that it's best to invest in situations where you think management's generally doing a good job, or situations where management's generally honest and good business people, but maybe haven't had the initiative to drive the company forward, or haven't done things like put in place a 3 and a 5 year plan for shareholder value creation, and whatnot. And usually it's a bit of a red flag if management doesn't own a fair amount of stock, because the companies are small enough that the CEO should own 5 or 10% of the business. If you have a situation where management's over 50%, you're not in a position to exact change. So I usually invest in situations where management has skin in the game but is not outright in control. And I've found that if you build, a 5 or 6% position in a stock, you have everyone's attention, everyone's interested in who the new shareholder is, and people are willing to talk about strategy and what direction to take the company in. I most recently did that with a company called Scientific Industries, which was a $7 million market cap when I bought in a couple years ago. And I did exactly that. I bought a 5% position, started going to the annual meetings. They had a vacancy on the board, invited me to join. And we've really changed the strategic direction of the company, like radically, and introduced some new products, made some new hires, and the stocks really reacted well. So I think that that's a really, cool strategy that people can do that is not available in larger companies.
I mean, I want to be respectful to these often amazing entrepreneurs that create companies that get some scale, maybe go IPO, like the examples we're talking about. But we also have to be honest here. A lot of them don't necessarily have tremendous pure business backgrounds. They don't necessarily come from either activism or institutional investing. Many of them are not, former, McKinsey partners with deep business strategy. But again, I'm not disrespecting their entrepreneurial spirit. They took something from more than nothing, and kudos to them. But therefore, that inefficiency and lack of strategy creates the opportunity, assuming they have enough skin in the game, but arguably not too much where they'll always have control. But you would think they're going to want to do financially better than they're doing, and they would look to say, hey, I may be great as an entrepreneur and an initial business builder, but there's others that may be better than me, whether in a board position or potentially an advisor or C-level executive, that could take it to another level. Now, I know a little bit how entrepreneurs think, and sometimes it's hard for us to relinquish that or let that go, but this must be something that you dealt a little bit with on the company you mentioned, and something that you must see going on in the community.
Yes, so there's it's hard to generalize because this market is kind of like an oddball market. There's different situations, different personalities. And I think one of the most important distinguishing factors about a company is why it's even public on the over-the-counter market. Like a lot of these companies, it's not clear that they like should be public companies. And I think the main ways I've seen companies drift into this market is one is that they just decide that the listing rules of, you know, the New York Stock Exchange and the NASDAQ and being an SEC filer are too onerous. And so it's a cut, and maybe this is what happened with Callaway's. They did an IPO, they didn't really hit their numbers, the stock under a lot of pressure, it wasn't meeting the listing requirements, and it delisted. And so now it's in this like purgatory limbo of like, where do you want to be in 5 years? And a lot of companies in those situations are shell shocked from, you know, the events that transpired that led them to being delisted. And if you're a CEO, an ambitious executive, as opposed to just a value investor, it's not generally like a good thing on your resume that you were the CEO of a listed company and then it got delisted. It can be fantastic for a new investor coming in at the new valuation. So I think a lot of these companies need to be kind of reinvigorated at times. Sometimes and generally if I invest, they had a difficult period and now they have a trajectory of, you know, rebuilding from a new base. And usually for those companies, they should develop like a 3 or 5 year plan and either get back listed, which, you know, can be a value accreting event, or sell the company. And usually the shareholders around the table are really aligned around those goals. People tend to be wary of a new shareholder that wants a quick, you know, upgrade in value. And I think, but for anyone who has equity in a business, I think a 3 to 5 year time frame to think about this makes sense. And you have to, like I said, you have to get them kind of out of the mentality of you know, this purgatory if you got, you know, delisted or deregistered, delisted or deregistered. And in Scientific Industries' case, I should mention, like they've been a very successful company for a long time. They went public back in the 60s when it was common in the US for small companies to go public. So they didn't have an event where they were, you know, riding high and then got taken down and had to reset. And so I didn't want to make that comment applied to them, but I think everyone agreed there that we should rethink a business strategy, and everyone got together pretty collaboratively and did that.
Yes. So this does beg the point that someone of significant wealth, a family office level, I mean, they could, you know, have a significant impact in not even just 1 or 2 companies. And really, if they want to really put their time and effort into a basket of securities where they're going to be impactful, whether they want that or not, and of course, understanding the risk. But at the end of the day, they probably are investing. I mean, maybe some of it is the pursuit and the passion of investing, building great companies, taking it to another level. But let's also be honest, for all of us, we want to have a return that would justify some additional risk that we're taking. So at the end of the day, maybe the company, just their strategy and their trajectory just starts to go up and up, and simply over time, the stock value goes up, the Warren Buffett approach over decades and decades. But there is an appeal to what you did. And again, you might have got a little lucky, but doubling the money on the first investment. What are ways, I'm assuming one way is, hey, I'm a connected, ultra high net worth person and family. I'm making a highly strategic investment. I'm going to inform other investors. I may know people that maybe, I don't know, you know, someone at a public company where you could be a takeover target. Now, I want to be careful not to look like it's trending towards, you know, having control behind the scenes and doing things that someone shouldn't be doing. So we'll be careful on our answer. But they could rattle the cage in the microcap industry quite a bit. Families of great wealth, they just really haven't done it yet.
I think that makes sense. I mean, I think any investor should be drawn to deep value situations where you have an opportunity to invest in, you know, Warren Buffett says invest by $1 for 50 cents. And those don't exist in the more efficient markets today, but they do here. So it's very common to see very large takeover premiums in the over-the-counter market. There was an insurance deal in the last month, a company called Gainsco, that was a long time OTC stock that people followed. It was created a deep discount to book value that State Farm just bought at 3 times the stock price. So, I think investing into a company with good management, decent governance at a deep discount should be of interest to any investor. Like, value investing is less in vogue today than it was 10 years ago, but in spite of that, that should interest people. And I think a lot of family offices have, talented, staffs, or in some case, or an entrepreneur or a public figure who's the source of the wealth that can, get involved and add value. That can be an important catalyst, I think, in certain situations. And you have much more access in this market than you would in other markets to make a difference to move the needle on an investment.
Oh, for sure. In multiple different ways. I mean, even a significant family, with rare exceptions, is going to be able to move the needle on any probably mid to large cap company, unless they want to put all their billions into it. But this is a way where, it could be very impactful at much, much less dollar amount.
Like Shaq joined the board of one of the pizza companies. I'm blanking on the name right now, but in the over-the-counter market, you don't need to be Shaq to get the board seat and move the needle on strategy and whatnot.
And you mentioned some of the complexities, even in North America, but arguably with the SEC's greater involvement, that might, in its indirect way, might improve. But how about internationally? In Europe, in Asia, they have their version of micro and nano caps as well. And let's assume I want to explore that universe. How do I get data, and how do I move forward with a brokerage arrangement? How do I purchase more globally or internationally?
Brokerage access is an important topic, even in the U.S., because before the SEC cleared things up there last week, and it remains to be seen how the brokerages are going to react to that. But they're being told now what the line is where they're allowed to, have customers transact. In the past, I saw a real erosion in the last 5 years of, broker appetite. So like, I had a Fidelity account, and then at some point, Fidelity made a decision that they didn't want customers active in the over-the-counter market, and they wouldn't, you'd put in the stock trade, and it wouldn't, error sign would come up, and I migrated to Interactive Brokers. The same thing happened there. And most recently, Schwab and E-Trade have been kind of the two most accommodative brokers to the over-the-counter market. So, if you call their customer service, they know what you're talking about, and they don't, whereas other ones have kind of blacked it out. I don't do a whole lot of international trading. I think that I'm most comfortable in the U.S., just knowing the rules of the road here. But there are, value investors and microcap investors that find, terrific opportunities elsewhere. Because the brokerage situation's been so difficult in the U.S., I don't have a great point of view on how to go to for Europe or elsewhere. I think, like I said, I think Schwab and E-Trade have been the most accommodative, most helpful, and most interested in doing business with people active in these markets. So I would probably start there.
And we're getting some questions in, and it was going to come up a little later in the conversation. I'll ask my version of it, then incorporate some of the questions coming in. Could someone, just like small, mid, and large cap or more traditional public equities, with my brokerage, could I use things like leverage, arbitrage, margin? Is any of that possible?
No, not really. So like I wouldn't advise buying, microcap stocks on margin. I wouldn't advise buying large cap stocks on margin right now. I wouldn't advise, the market's very expensive right now. And, you can, I think on some of the brokerage platforms right now in the liquid markets get, 5-to-1 margin at very low rates. And that's not for me and it's good that it's not for me, because in the market I'm active in, the microcap market, a broker won't provide a margin loan. You're lucky to, like I said, to find a broker that will transact your business.
To begin with.
So yeah. I think, people can earn attractive returns commensurate with leverage returns, but they can do it on an unlevered basis if they're, picking the right situation. So that's what I would advise. There's also not really short selling in the market. So
that's one of the questions.
Yeah, I saw that pop up. I wish there was, because I think, there should, when you see situations that are overvalued or maybe you suspect fraud or whatnot, the opportunity to short would be attractive. It's just very difficult for the brokers to source stock to borrow for the short, and they're so thinly traded that they could be subject to spikes in the price that could do a short squeeze. It's a volatile enough market that it should be traded unlevered and just on the long side, in my opinion.
And in terms of some trendy sectors, some that would pop to my mind: biotech, oil exploration, although not in the US, but in Canada, cannabis, public cannabis companies. I'm sure there's others, and maybe COVID has impacted, as it probably has with biotech. But talk a little bit about kind of what's hot right now.
Yeah. Well, a lot of people, when they think about microcap and OTC stocks, get excited about biotech, get excited about mining and oil and gas, like you said, for that like home run potential. I find a lot of those stocks to be very difficult to analyze, and so I think there's probably someone out there who's a mining expert or a biotech specialist who would trade those markets. I find a sleepier strategy to over the counter to be more interesting, and a deep sector for that is community banks. There's hundreds of over the counter community banks, but the broader markets today are being driven by tech companies that have network effects, that have very high growth, that are fantastic businesses and that have scaled. So the top 5 S&P constituents are now 20% of that index. These are big companies and great companies. There's a question about whether today's price is the right price, but it's undisputable that they're great companies. So I focus mostly on more value situations where you're buying at a very low multiple of cash flow. But in these markets, there are also some very good businesses. They're just fewer and far between, high growth businesses. So 2 I would mention are, there's a company called Liberated Syndication, which is the over 90% market share in podcast hosting, growing very fast, trading at a reasonable multiple. It's about 100 million market cap. And that's kind of an exciting growth, tech network effect type stock. It's trading around 12 times EBITDA right now. So I think that's interesting. Actually, OTC Markets itself is an over-the-counter traded stock. I think it's also growing very fast. It's doubled their business in the last 5 or 6 years. And my interpretation, my early take on the new SEC rules are that OTC markets will benefit from it because they're likely going to be the interdealer quotation system where companies have to post their financials and they charge the money for that. So it's very fast growing. I'd encourage people to look at it. It also has a 4% dividend yield, very good management. And then, cryptocurrency is another one that people get interested in. And I don't really have a point of view on Bitcoin versus gold or anything like that. But there's a stock that I wrote up in my letter a couple months ago called Mechanical Technology. They have gotten into cryptocurrency mining through an acquisition, and the early indications are it's going pretty well for them. So, they're if this business plan plays out, they're in a fast growing market and, a sexier company. But I got interested in it because it had a good base business that if the mining effort didn't work out would still probably justify the stock price. So there are some interesting growth situations out there, but it's much more common in the way I look at investments to find, a bank trading at a discount to book value or an industrial business trading at a reasonable multiple.
And in terms of kind of sourcing for new ideas, I guess you would have post-bankruptcy reorg, think of kind of Tropicana Entertainment, companies that choose to delist from exchanges, at times deregister from the SEC filing. If you could talk a little bit about some, creative ideas in terms of sourcing?
Yes, I mean, you hit two of the main areas that are a source of new stock in this market. So one is, companies that become over levered and go through a bankruptcy process. It's very common for the bankruptcy claims to convert to equity, and then typically that equity starts trading over the counter, and the holders are not natural holders. So they're the former leveraged loan buyers. And Tropicana was a great OTC opportunity a number of years ago. It went bankrupt in the financial crisis. It came out of bankruptcy 2011, 2012, and it was just trading at a great value. It was around 15 or 20 bucks a share for years, and then they sold out to El Dorado a couple years ago at around 70. So that was a lot of the larger, more institutional type companies come out that way. A recent one is Brink's Home Security is currently trading over the counter at a pretty interesting valuation, and it's controlled by the former bondholders. So that's an interesting area. And then there's the area of companies, and I kind of touched on it earlier, that maybe they were listed and they, it in many cases is over $1 million to be a public company, and they want to save that, and they, deregister or delist from exchanges, and they enter the market that way. And then the last area is there are companies that kind of just fall into being public because of the number of shareholders they have. And I'm not an expert on all the regs on this, on when you hit that point, but and a couple of favorite stocks in that area for OTC investors are J.G. Boswell, which is a big farm owner in California and Australia, and a company called Hanover Foods. Those right now are the toughest area for me, because those are the companies that tend to be the most reluctant to put out financials publicly. Both the companies I just mentioned are in that category, and I don't know that they've had time to react to the new SEC rules, but there's a chance that they won't comply, and they'll kind of be effectively private companies at that point.
And it pops in my head, and again, it makes me think again of more barbarians at the gate and back in the day, but still happens today. How does LBOs potentially play into with micro-cap companies? Is that potentially what a takeover artist or an activist may look at potentially using?
Yes. So I mentioned earlier that you see bigger acquisition premia in this market at times, and as of late, a lot of it has been financial sponsor backed takeouts. What I haven't seen, which surprises me, is that the sponsors, in the 80s, there was this concept of the sponsors building a position in a public company and then taking them out, and it's really gone away. I don't know if that's because companies don't do green mail anymore, so like offering to buy them out to avoid the takeover. For whatever reason, that's not that common in the larger market. And I don't see it in this market either. I've had a number of situations where companies get sold to a private equity firm or a portfolio company of a private equity firm, but I never see it that the private equity firm built an 8% position beforehand. And it's probably because it's just not their strategy and it doesn't move the needle, but I think it would be an effective way to make more money on an investment.
Oh, for sure. We're going into the next topic, understanding that none of us are tax attorneys or accountants. We are not going to do a super deep dive in it, but I think it's worthy to touch on it a little bit. Potentially, there may be some tax advantages to investing in certain kind of companies like this, and perhaps insurance and banking potentially could be one. Whether someone would need controlling interest, again, that's a little bit of a complex tax issue. But if you could talk a little bit about some of the issues around net operating, a loss carry forward, pass-through structures, acquisitions, or simply long-term capital gains.
Yeah, I think regardless of anyone's politics, taxes have become a bigger issue than in the past. I mean, when the tax cuts occurred in 2017, it led to the rally in the market that year. I think most people, I think Biden has the slight edge in most polls. Although I don't follow it that closely, it seems like there's a decent chance he'll get elected. And he's come out with a, pretty material increases to taxes. So I think his corporate tax plan walks back Trump's tax cuts by half. So going from 21 to 28. I think that he's examining increasing dividend tax rates pretty materially. So people should pay attention to it. There's a big part of this market of companies that have very material net operating loss carry forwards, meaning they lost money in the past, and due to IRS rules going forward, they can offset income with those losses. And at times those can be mirages, because it's like Mechanical Technology, the company I mentioned earlier that is moving into cryptocurrency mining, has a $50 million NOL as a result of a different business line than they're in today, where they lost some money. It's very easy to slap a 20% tax rate on that and say that NOL is worth $10 million, which is close to their market cap right now. But there are expiration periods. They need to find a profitable business to get into to use those. But it's an area that some investors have been very successful in, is investing in companies with NOLs and working with them to utilize them. So that's one comment I'd make. I think long-term, shifting as much of your capital gains to long-term is an obviously important strategy. And, this is a market where people tend to hold positions longer than a year, so it leads to that. There are a few more kind of pass-through entities in this market. In the larger liquid markets, you have REITs and MLPs. I've seen more kind of like oddball pass-through type structures here. There's a stock I wrote up 2 editions ago called American Restaurant Partners. It's a traded limited partnership. They own Pizza Hut franchisees, and they don't pay taxes. And so it's investing in that business. You're subject to increases to dividend taxes, but the corporate tax rate doesn't matter to that company.
And isn't that dividend for that company rather substantial that they're paying out?
It is substantial. I would caution people because, and full disclosure, I have a long position in that stock. I'd caution people because I think they're very likely going to move to the gray market and be very difficult to trade. And they're paying out a dividend yield in the teens. So I'm kind of happy holding that for a long time. It's a very stable business with a franchisee of Pizza Huts. So I don't expect to ever trade that stock, and I expect to clip coupons to the tune of in the double digits going forward. So it's a really cool opportunity. I would hesitate to recommend it, just given that they may fall on the wrong side of this new regulation, and I should disclose that I have a long position in the stock.
Of course. And I will take a pinch of a timeout just to remind people, one of the things we mentioned earlier, we are talking about investments. We're doing this for educational and entertainment perspectives, although technically not applicable to really anyone, I guess, that would have a specific account that could buy micros. Angelo's recommendation would likely be that you would be a significant and experienced investor. Again, my audience is mainly focused on the most highest level at the single family office level. And even then have to question, what resources do we have? Do we have enough diversity? This should probably only be a tiny percentage of their portfolio in general. And you need to do your own diligence. There's bad apples out there. These are not efficient markets. There's lots of things that could go wrong. And maybe just like investing to some degree in a startup, you should assume that maybe all your money goes away. You need to have, what's your investment allocation, your investment policy statement, what's your time horizon, your allocation, your percentages. There's lots of different questions. You need to do your own diligence and research. Again, this is strictly for knowledge, and you would even say from an entertainment perspective. So just understand that.
Yeah, and I would add to that, use limit orders.
Yes.
The worst thing to do is to come into an illiquid stock and with a market order, and that's a big mistake. And I'd echo everything Angelo just said about you really, in this market more than others, you really need to do your own due diligence, and I don't take any of what I say as a recommendation.
I mean, I'm even going to say that even for single family office level families, and maybe some of them are gigantic at billions, and this is just simply too small. But broadly speaking, probably most of what we talk about is not even going to be applicable to them. It's not necessarily what they should be doing. This is, again, in my opinion, for a very, very limited audience, even within that utmost of the private quasi, at least from a family perspective, institutional level investor. Let's talk a little bit. It's going to sound a little off topic, but it's not. And you brought it up from hearing some of my past podcasts. And I don't mean to be a cage rattler, but I am going to talk about custodial issues. We are not going to do a deep dive into, I go in my brokerage account for a traditional stock, whatever, a large cap, I buy it. Well, I guess we are going to dive a little bit into it. It's in the street name of the broker dealer. It's ledgered internally in your name, and the records are going to be applicable. But when it goes to the DTC and all of that, now, is anything going to go wrong with that? I'm 99.9% sure no. But if I'm a significant investor, there's some concerns there that I would have, and I do talk about this more significantly in my masterclass. But I would like your opinion, especially with micro-cap stocks. And for a family where I just said that and now they're a little concerned, what are some possible steps they could take to mitigate what, again, is probably an ultra tiny risk of everything going to hell in a handbasket?
Right. So you're right, Angelo. When anyone purchases a security in a brokerage account, the way the infrastructure of the system works, you're a customer of that broker, and that broker shows up as a shareholder on the register, which is, companies use something called a stock transfer agent, and there's a few out there, and those are the companies that maintain the shareholder register. And when the company wants to communicate with shareholders, whether it's an annual report, a proxy statement, or any other update, they provide it to the transfer agent, who shares it with the shareholders of record. The shareholder of record, if you own it in a brokerage account, is your broker, not you. So then it's the obligation of the broker to then share it with you. The benefit of that system is it leads to more efficient trading. So in situations, and I'll get into how you do this, in situations where I've held stock at the transfer agent, it's very difficult to trade the stock because the transfer agent can't route orders to any market, whether it's an over-the-counter market or an exchange. And so generally, if you want to sell your stock, you need to take it back into the brokerage form. And taking it from the broker to the transfer agent, or from the transfer agent to the broker, is filling out paperwork. And it's not rocket science, but it's a significant nuisance, and it's harder than it should be. So what I like holding stock in my name at the transfer agent in situations where it's a long-term investment, which is most of the time. And in particular, in situations where I want to have a dialogue with management or get more involved, I always want my name on the shareholder register, because they actually can't really confirm that you're the shareholder if you have it in the brokerage account. There have been times where I've sent a brokerage statement just to show I own 4% of your stock, but it's just more effective, I found, to own it direct. I like going to the annual shareholder meetings of companies that I have a big position in. If there are topics up for vote at annual meetings, and there always are, director elections and sometimes other shareholder matters, if you hold it in the broker, you have to give your instructions to the broker via a proxy, and then they issue the vote. Even if you're going in person, you can't withhold the vote and just decide at the time, and you generally have to make a decision a few weeks in advance. So for those reasons, I like holding it at the transfer agent. There are many things in our financial system that I think should be modernized. I think it's strange, this dynamic where it's not in your name, it's a brokerage firm, and I don't like it, but I can't really lay out a scenario where you would, like, lose your interest or something like that. I'm sure there's possible scenarios, but this is an owner of assets. I prefer it in my name, and I think most people would probably agree with that.
For sure. And one day, when governments, entities, quasi-governmental entities get a little more modern, which probably will be decades, blockchain potentially could be one way to solve this issue. We're not there yet. And by the way, we are there in terms of the technology and blockchain. It's just the other factors and some political reasons involved where it's just not going to happen anytime in the near future. Let's talk, and we probably have a little bit of a limited window of about 10 minutes. We already discussed buying a large enough position, potentially getting board representation, and ultimately, possibly for those interested, control. But you had another idea regarding Optech Systems, and I know that's a company that you do have a long position in, but if you could talk a little bit about the decision you made to invest in them and the fact that there is, I think, one or two small but OTC-centric hedge funds that are involved. So you could argue that, hey, Angelo, they probably did deeper diligence than me, so I'm kind of piggybacking on them a little bit. But if you could talk a little bit about them as maybe like, we'll call it a company profile.
Yeah, sure. I'll share that idea. And like you said, I do have a long position in Optex, although it's a fairly recent purchase. So it's around, where it's trading today. It's likely, what I'll write about in my next edition. And so I'll just go through kind of how I found it and why I thought was interesting about it. So I found it, through actually some stock screens I was doing. They're a manufacturer of optical systems for the military. So their primary product is tank periscopes, which are not like whatever your mental image of a tank periscope is not what it is today. They're very high tech equipment. Optech is a sole source on most of their products, meaning they're the only approved producer for U.S. military, and they make they go in binoculars on naval vessels, periscopes on tanks, and other sighting systems for the military. And so they've got a good trend behind them. Soldiers today and military equipment today has more optical equipment than it did 20 years ago. Mm-hmm. There was a dip in Department of Defense spending around 2012, 2013, coming out of the Tea Party movement. But actually, and your opinion as a taxpayer on this, whether it's good or not, is another topic, but it's factual that, defense spending has grown. Everyone's trying to read the tea leaves on, Biden's potential policies. He's said he's not planning on cutting defense spending. What ends up happening remains to be seen. But it's got some good wind at its back, and, it's been growing double digits a year. The screen I did that it emerged from was companies that have been growing fast, that traded at an attractive multiple, and that actually grew their business in the quarter ended June 30. And it's not a very long list, of companies that fit that criteria. And, going through the list, weeding things out that have issues with them. I found that this company is pretty attractive. Their market cap's around 14 million. They're doing about 25 million of revenue a year, around 4 million of EBITDA a year. So it's trading at a sub 4 times EBITDA multiple. The CEO's publicly noted that he's planning on uplisting to the NASDAQ. The CEO and the CFO together own about 11% of the stock, which is a healthy level, but not enough where they control it. And you mentioned earlier that one of the details I pointed out is they're a good shareholder base. So, and these are not groups that I know well, but I know them by reputation. So there's a firm called Gate City Capital Management. That's a sub $100 million fund focused on over the counter. And then another similar investor called Echo Lake that together own over 20% and appear to have some influence. And so it's a great value situation, but a growing business with a catalyst on this uplisting. Not a particularly liquid stock. I think the bid ask this morning was something like 190 bid, 195 ask. So there's a little gap, and it probably trades around 20 or 30 grand of volume a day. So I think it's a really interesting situation, a company that's doing well in spite of COVID, and so it's something that I'm going to cover in my next letter.
And we'll buzz through some of these a little quickly. We touched a little bit on some of Angelo's favorites, insurance companies and banks. And by the way, when I talk about that, I do not necessarily mean from an investing perspective. I mean from a family wealth preservation perspective, often for very, very large and significant families, actually often offshore, and for different reasons and purposes than, again, strictly as an investment perspective. But nonetheless, by irony, insurance companies and banks happen to be among some of the more common options and probably greater on disclosure given they're very regulatory centric. So there is opportunity to probably do a little deeper diligence on OTC insurance companies and banks. And it could be interesting from an investing perspective.
That's right. Yeah, I mean, most value investors I find do something in financials. It's, if you look at the Russell 2000 index, which a lot of people compare to, even though it's a completely different market, it's, financials are either the top or the second sector. And then the Russell 2000 value index is like over 30% financials. And then there's just a lot of them. So I think in the US, there's a little under 1,000 publicly traded banks, and about half of them are over the counter. So it's a big market. Among the sector specific area, I talked about biotech and mining, and I think you kind of need to be an expert in those areas to dig in there. Financials are a little bit easier for the average investor, whether it's banks or insurance companies, to look at and understand the metrics. And so it's a big part of this market, and one that I think if someone has some expertise in insurance or banks, they can really find a lot of interesting opportunities. I kind of dabble in it, but it's a big part of the market.
True. And I would say some other ones, you mentioned a little bit before, from mining potentially being one to, blockchain technologies. We briefly mentioned cannabis earlier, and this may require a level of subject expertise. But if you're a family office with the resources, the capabilities, and the access to certain data, and you could simply buy it, it may be something in, the capital IQ that we mentioned earlier. I think for an average investor, that's just ridiculous, that price. But again, for a family office, that's, in theory, you would think nothing. But do you think, given COVID, and like we're seeing a little bit with FANG relative to technology, online retail, meaning online retail, not traditional retail, gaming, if you have a given knowledge base or access, those could be interesting markets.
Yeah, I think that's right. The number, like I said earlier, the number of stocks trading in the over-the-counter market actually greatly exceeds the exchange traded market to the tune of 2x. So you almost pick any sector, and there are things to do in the over-the-counter market and opportunities to look at.
And how about like the M&A market? There's a long history of OTC insurers being one that has been brought out at large premiums relative to the stock price.
That's right. I think that in the microcap market, there's two key catalysts that you don't have in the larger market. So one is being an acquisition target. Just given the size, they fit in nicely with acquirers. And then, uplisting, which I mentioned, Optex might look at, but the premiums that are extracted when these events occur are very large. And I mentioned an insurer, Gainsco, recently, but there are others. There was a insurance company, Investors Heritage Capital, that I was in a few years ago that got bought out at a similar multiple. And the same with the banks. Even investors in the listed regional banks, M&A is often like a key catalyst, and it's certainly the case in the over-the-counter regional banks as well.
And we covered it kind of, but I want to make sure that I understand it. For someone that does take a moderately significant, well, probably more than moderately, whatever, 5, 10, 15% in an OTC, and for whatever reason, maybe it's doing well and they now want to exit like you did with your first one. Perhaps you should have held on earlier, but looking at a 2x multiple wasn't so bad. And you probably, again, at that time with mitigating your risk, might have made a good decision. But let's even say it doesn't work out as well. When you own relatively a decent percentage of such an OTC company, how difficult is it to get out of that position, to sell?
Yeah, well, I talked a lot about positives, and the liquidity is a negative on exiting a chunky position. If you are, in the Callaway's nursery case that I described, it took me probably 9 to 10 months to build my position. The volumes picked up because there was a positive event at the company and it changed directions, more people got interested. And so it was much easier to exit given the increased interest, and I probably exited over a 2-month period. If that does not happen, if things go sideways, it's probably, a similar challenge to get out without moving the market adversely as it is to get in. So, I think that it's a significant, liquidity is a positive for an investment, and part of the reason why this market trades as attractively as it does is because there's not great liquidity. So big investors can't look at it. Even smaller investors, when they get in, harder to get out. So what I would say is people have to be smart about their position size as a percent of their portfolio. Like a lot of value investors, I feel like almost wears a badge of honor that they have a concentrated portfolio. They have like 3 positions they like or 6. I think it's actually kind of attractive to have a higher number of underlying positions and a less concentrated portfolio, and it makes exiting a lot easier. But if you have a 5-6% position in a OTC stock that's maybe 20 million market cap, you're probably looking at a couple years to leg into the position and maybe a couple years to get out. So it's somewhere in between private equity and public equities on that basis.
Right. But from an investor perspective, don't think, especially in larger positions like that just because it is technically a public company, that you have near instant liquidity. Often you don't. And again, these are all the things that we keep on repeating. This is a very intriguing market. Yes, there's opportunity. There's horrific inefficiencies. But again, there's frauds, there's bad apples. There's not, even though they're public, and not quite enough transparency as we would like. And you have to realize that liquidity is very, very limited, even though, again, technically it's a public company. This is a very, very difficult market, again, in my opinion, for qualified purchasers plus, leaning more towards family offices. That's being ultra conservative on my part. I know it, but just from my perspective, that simply is what I would say. And again, for everyone, this is educational. Do your own diligence. Talk with your advisors, your financial advisor, your legal advisor, whatever, to be sure that any investment, even 1% allocation, is going to be quote unquote applicable for you. Marcus, as we're wrapping up, for those that would like to subscribe and learn more about your microcap and OTC stock letter, how could they learn more?
Yeah, so I publish it monthly, and and it's free, by the way. I do it just to help foster my thinking and to put my thoughts on paper and to interact with like-minded investors. So everyone's encouraged to subscribe to it. It's at www.microcapletter.com, or if you find me on LinkedIn or Twitter and send me a message, I'm always happy to interact with people.
Great. And that's Marcus, Marcus, Frampton, Frampton. And again, founder and writer, author of the Microcap and OTC stock letter. Marcus, it's been great to see you again. Very exciting to have you back, this time to focus strictly on this market. Again, like I said earlier, sometime in the coming months, we'll have you on wearing the other hat from CIO of the Alaska Permanent Fund and talk a little bit about the markets now that we would be much deeper into COVID, as well as post the US election. So lots of intriguing things to talk about in the months to come. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast, and I'm founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices. We do a significant amount for our members of proprietary content. We host global programming, limited now because of COVID, but we do hundreds of times a year digital programming practically every day for our members. We have great guests like Marcus. You have a chance to hear it first, to interact, to be live. And much of what we do never makes it up to my more public platforms, whether website, YouTube, or podcasting platforms. So there absolutely is a intellectual advantage in terms of being active and being a member. We have a significant amount of family office masterclasses, and you can learn about much of this on our website, which has been new and updated over the late summer. It's familyofficeassociation.com. I'm very active on social media. Follow us, YouTube, or simply Family Office. So we're Family Office Channel on YouTube, Family Office Association on Instagram. We're very active on LinkedIn and Twitter as well. My direct email is angelo@familyofficeassociation.com. We hope you enjoy this interview. Marcus, thank you so much for your time today.
Thank you for having me on, Angelo. I really enjoyed it.
It's always my pleasure. Thank you.